Double Diamond, aka Double D, Dave Bliesmer. Dude, I've been working on that intro for a long time. Did that not work?
I like it, buddy. I,
Dave,
I think
let's
roll with whatever you want.
okay. And so let's get started here. We're gonna let this thing fly here, and we'll start with let's talk about rate roller coaster. You know what I'm talking about. We're seeing it the last few weeks, I think. Why do you think we're seeing this crazy shifting of interest rates that we're seeing?
Well, I think it's obviously stemming from, uncertainty with political policy, specifically in, trade definition. And is tariff policy going to hold true? Is it going to back down? What are the implications on inflationary pressures? The bond market doesn't like that. So I think if we get some stability and predictability, so to speak, out of just trade policy in general, I think we will see the markets work a little bit more fundamental. But right now, I think they're just not working fundamental because of all the uncertainty that's out there in the market right now in the geopolitical environment.
Yeah, and it goes to say, like, for bond investors, for people who have money in the bond market, what we're learning and what we've always known is that their number one concern is stability. Like, what's happening with the international, the world of tariffs? Like, how's China and America getting along? Even these, I always talk about this on my Instagram. I talk about how even when the president just says something, like he could simply say China sucks. And the bond market will take that as a personal threat that it's going to hurt their investment. And you'll see a sell-off. Is this real, Dave? Like, is this how fragile our market is?
I think it's fragile in the sense that, I think a lot of investors, globally speaking, I think are just kind of watching to see how China reacts to some of those comments, in my opinion. Because, obviously China has such a huge holding in the US Treasury market that, if they decided to liquidate and sell, I mean, that could definitely, throw the markets upside down. And I
Yeah,
think investors know that, right? And I think they're just kind of waiting to see if everybody can get along, so to speak.
I've heard both sides of the story on this. I've heard that, yeah, China owns a lot of our debt essentially, and they're making a lot of money on it. Make no mistake about it. And I think what I'm hearing is China would never let go of all those assets because there's no market in the world. The nearest market to what they would make on that is like in Germany, and it's about 1/10. So sure, they could just liquidate and say, screw you, America. But why would they want to quit making so much damn money? Because they're making a ton of money in our market. That's what I'm reading. But it doesn't even matter though, Dave, because you and I know the mere thought of them doing that was enough to kill the market a couple weeks ago. We saw this. Both markets sort of tanked at the same time, which is a rarity.
It is rarity. And I think you're right. I think it was just fear driving the marketplace. And, I think fear is, basically spawned from uncertainty. And again, I think, markets in general like some type of predictable environment. And when that predictable environment is skewed, I think that's when fear goes into the marketplace. So again, I would say, my opinion, I don't think the market's necessarily working fundamentally at this stage of the game. But at the same time, I think if we do see some consistency in trade policy, consistency in the geopolitical environment, I think things will calm down. And I think we will potentially
Yeah.
see that consistency because, it's interesting. You can see some forecasts out there still have 30-year fixed rates coming down as the year goes on. I do think that is feasible, right? Because if we do see some type of consistency in the market, I think the market will react accordingly.
Is it your opinion that we're still going to get a couple rate cuts this year? Like, what are you believing on that? What are you seeing there? Because everything I've heard is that was always on the menu, but that was before we saw the whole tariff matter. However, Dave, before you answer that, it has stabilized because you heard Trump say, we're going to help, we're going to work with China. Or he said something about where those tariffs are going to come down very soon. The minute he said that, it just injected stability in the markets immediately. And so, how do you feel about that? What are you telling your clients about rate cuts this year? Because that's a question we get every day.
Yeah, I mean, it's again, I think at the end of the day, nobody knows how that's going to play out. But I would say this, I am a firm believer. I think the Fed domestically here does a very good job of remaining sound to their fiscal policy. And I love that they're always looking at the data right? The Fed's not necessarily making decisions based on speculation, and they're not making decisions based on emotion or these what ifs of what could take place in the market. They're always making their decisions based on the hard economic data that comes out. So, I think, in my opinion, what we should probably expect to see is if the markets do calm down a little bit and get a little bit more predictable, I think it just means the Fed's going to be doing what they always do, right? They're going to be looking at jobs data, unemployment, trade deficit information. They're going to still be looking at the hard economic data that they always look at. And I think at the end of the day, I think, the labor market and the inflation environment, I think is still going to drive that decision. I think if we see inflation continue to plateau, and I think if we do see some stability in the job market, I don't know, I think it is probably realistic. We could see them revisit some cuts.
Yeah, and next week's going to be pretty big. We know we have a ton of we have JOLTS Tuesday, we have ADP on Wednesday, we have jobless claims on Thursday. And what are you hearing in your circles? What are you thinking? Any tip offs there? What could come through, and how that could impact the market?
Yeah, no tip offs necessarily. It's interesting because if we look at those data reports up to this point since the first of the year, most of the data has been relatively on track with where the expectation was. And I'd be curious to see if that's going to be the same as we get into the month of May. And I agree with you that first Friday of every month is the big one, right? I think
Yeah.
that's where we would see markets jolt up or down in terms of our bond market and mortgage-backed securities. But I also find it's interesting, like we haven't really seen the data vary too far from where the expectations were
Yeah.
over the last few months. So I think it'll be interesting to see where it comes out, but I'm wondering if it's going to remain relatively consistent.
To me, Dave, every time we get a trend going in the market, whether it was pre-COVID or pre this tariff thing, which we've known the tariff thing was going to come into play for a while. There was talk about it in the whole campaign, but we have a market that is running in, let's just say, lane A. And then something big happens and we jump over into lane B, and it's totally crazy. It was like 2020 when all of a sudden, we were on track. It was predictable for about a few years. Rates were in that 4 or 5 range. We were comfortable. COVID happens. We jump over into lane B, and all hell breaks loose. Rates are in the twos and it's like, and we forget that we're in lane B. And then we come out of COVID, and then we try to get back into lane A, and people are like, what is this crap? And really, we're only 1.5% higher than we were when we were before COVID. But we, as people, have such poor memory of it seems like to me. And I've just been thinking about this a lot. And I feel like and the tariff thing is kind of like a mini COVID thing, right? It kind of threw us off. But we're going to get back into lane A quicker. Is that kind of what you're seeing or what you've seen?
I totally agree because I think what I'm hearing you say is, a lot of the reaction to the market is also based on perception, right? So if consumer perception
100%.
is looking at, 6.75 mortgage rates, saying, my gosh, those are astronomical. Well, I mean, as you and I know, if we look at, 30-year rate history, per Freddie Mac since 1971, if we kind of throw out the anomalies, right? If we remove the COVID era, if we remove that 1980 when rates were double digits, I mean, really fundamentally, if we're looking at things back to 71, I mean, if we're looking at 6% fixed mortgage rates, that's pretty close to average. So I think perception will come around, and I'm starting to sense perception is already coming around in a lot of conversations with people out there in the market. I think consumers in general kind of understand that COVID was an anomaly. We're probably not going to see rates go screaming downward like we had back then. So I'm getting kind of the vibe from a lot of consumers right now that they are starting to share our perspective on that. Right? If we see a 30-year fixed rate go under 6% into the fives, that is a total success
That's a
and
flood.
quote
That's a
unquote a
floodgate.
normal market.
That's a floodgate number, isn't it?
Yeah.
5.99 is a floodgate number. I think when that headline hits, and this brings me to my next topic here. Do you think that once we get that floodgate number, and maybe it's not 5.99, but when we get that floodgate number, do you think we're going to have a problem with inventory again, Dave? Do you think we're going to fall into that trap?
I mean, it's a great question. I think the tricky thing as we get into the inventory conversation is, it's so different from one geographic area to another geographic area where, I think there are certain areas, like if we look at this as a whole, right, within the country, I think there are certain areas where, inventory isn't as strained as other areas are. So I do think if we're going to isolate this to our conversation, right? Let's say we're in the front range of Colorado. I do think we are still going to have some inventory pressure. But at the same time, we're also seeing more homes on the market than we've seen in a long time. So I think it's slowly correcting itself. And it's, I'm optimistic with this point of view, but, a lot of people are talking about that lock-in effect where, people that have these rates under 3%, aren't going to sell. They're not going to move. They're going to stay in that home forever. I think that is true for some of those people. But I also think, if we look prior to COVID and we kind of look at refinance behavior just as an industry, generally speaking, a lot of mortgages turn over every 4 to 5 years, whether that's a refi, whether it's a sale. And, I think what happened is we're still kind of in that 4 to 5 year window post COVID. So life hasn't happened yet. I think going back to your floodgate number, I think if that were going to happen today, I think we would see some inventory challenges. But I also believe if those people that have those lower rates, if we saw rates in that mid to upper 5% range and you were sitting at 3% and now you're looking at a downsize, well, let's say you were going to finance $100,000, right, on that new mortgage at 5.99, as opposed to your $300,000 mortgage that you've got at 3%. I mean, in that case, I would argue, why stay in the home at the bigger mortgage when you can go over here, still downsize, have a lower payment, lower
Let
interest
me
paid, et
that
cetera.
that brings up a really good point. And do you think people, consumers, buyers that we talk to, do you think they get hung up a little bit more on interest rate and payment than they do on the equity they're making in that house? I mean, how many people, the first thing I do with a client when I'm doing a refinance is I pull the value of the home over the last 5 years and I do a little comparison. And I essentially determine how much equity they have gained or how much, I guess, money they have made on the home itself. And then I tie that into the proposed mortgage payment or, whatever we're doing or the new home they're looking to buy. I think consumers and buyers, myself included, we get so hung up on the water cooler conversation of the interest rate that we forget that a home is an investment that is like a job. It's like a $35,000 salary job. Um, do you ever think that way, or do you ever dive into that with clients? I mean, I know it's a slippery slope because we have to talk about cash flow and we have to be able to afford to live. But for me, you have to take a broad approach to your money. And you have to understand that, yeah, home prices are going up. Yeah, rates have gone up, but equity is still making gains. And that is a factor that's an investing factor that needs to come into play.
It's very true. The short answer is yes. I think every buyer, right, needs to fundamentally keep in their perspective, they need to look at this from a large lens, right? From a financial point of view. On the same hand, which I always think is interesting, to your point on the water cooler conversation, it's interesting when you do hear somebody say immediately they're not going to move or they don't want to move, they don't want to entertain selling because of their rate. But again, it's interesting because we see this dynamic, in a lot of areas in our, region here in the Front Range of Colorado. They would have the ability to downsize if they chose to, or move out of state, right, to maybe a less expensive housing market, et cetera. That rate is kind of keeping them chained to that home. But it's interesting to me because if you looked at, for example, like, interest paid on a $500,000 mortgage at 3%, are they weighing what's the interest paid on a $100,000 mortgage at 6%? Like, are they actually looking at the dollar amount? Are they
It's a good
looking
point.
at the monthly payment difference?
It's
Are
a
they
good point.
improving their cash flow situation with the downsize? And if they factor in taxes and insurance, is it an overall better cash flow perspective? It's going to cause consumers to start thinking about those concepts.
Right.
in a little bit more detail. But I agree with you. I think right now consumers aren't really looking at their big picture all the time. They're just really focused on the interest rate itself without taking into account the dollars and cents associated to it.
Let's take this right into seller concessions
Yeah.
because I had a client recently who the seller, they were pushing back on rates. The whole center topic for us was always rates for the last 2 months. Oh, rates are too high, rates are too high. Well, they found a home they want to make an offer on, and they got the seller to reduce the price by about $25,000. And they got 15,000 in concessions. I mean, when you add up that dollar figure and you compare it to where rates are right now and what it's doing to the payment, and even hypothetically go back and compare it to what it would have been in 2021. And even though the payment is higher today, probably a lot higher, let's just say 500 bucks more, they're getting like $50,000. And when you divide that out, I mean, it's just a perspective that I think people have to look at the full picture. That to me was kind of a no-brainer because if you can afford that payment and the seller's basically giving you $50,000, the long-term play on that is that's better, even if the payment's higher, assuming you can afford the payment.
I totally agree with you. And I echo your sentiment. Like I think from a consumer's perspective, as long as you can afford that payment, right? As long as that payment's within your comfort level and your personal budget, obviously that's number one, the key factor, right? Everybody has a different threshold to what they're comfortable doing. Not every buyer is the same as the next. Let's say we never saw rates go down, 3% or less. And let's say we were always in this, 5 to 6% rate environment. I think what's interesting, right, is again, if we talk about that lock-in effect, well, I think people have kind of lost the perception too. Like if I'm going to make a move, I want my payment to be the same as where I'm at now, right? But let's say COVID never happened and rates were always 6% and you bought, your first home at 200,000. Now your family size has doubled. So you want to get the bigger home at 500,000. Like never historically would you have the expectation that those two payments are going to be the same.
Right.
So I think too, COVID kind of threw that perception off
Yeah,
with
perception.
consumers. Yeah, but I do think that
It's
perception will change.
everything is perception. You
Yeah.
hit it on the head earlier, and it's up to us to educate buyers, and I think our realtor partners to let them know, like, look, step back from the headlines for a minute, step back from what's being chirped at you in your ear, and take a broad look. Step back 5, 10, 15 years, and just kind of look at equity gains, look at the market, look at where rates have been, everything we've discussed. That brings up another topic that you actually brought up to me this week, and you gave me that Bliesmer phone call that I love. It's once a week I get this call from you, and it's usually something really awesome. Like you say it kind of like undercover, kind of cool. You're like, "Hey, have you seen the rates on those ARM loans?" And I'm like, "No, I have no idea." Meanwhile, I'm quoting conventional rates, and they're where they are. They're a little higher, and you're throwing numbers at me. Bottom line, Dave, is creative financing back?
Yeah. I mean, it's boy, this is another big perception thing to talk about, right? In terms of how consumers look at this, because ARM loans, right, cover a huge array of loan products. So I would say no, we're not back pre 2008, right? Because fundamentally the difference there was not were they just ARM loans per se, but there were option ARM loans where it wasn't even covering the interest due on the mortgage. So the mortgage balance was increasing
So
over time.
arm loans got a bad reputation,
They
didn't
got a
they?
bad
I mean,
reputation. And then, a
they're
lot of the subprime lending, right, was all ARM loans. But, I mean, let's face it, I think any consumer would agree if, just because you have a 740 FICO score doesn't mean that you should get a $500,000 mortgage with no income,
right,
assets, employment
right.
verified. So, I mean, there was just a lot of,
On top of that, zero down, no money,
exactly. Yeah.
no money, and no equity, no investment, stated income, arm loan. I mean,
Yeah.
what
I
could
mean,
possibly go wrong there?
totally. I mean, the industry just got kind of irresponsible, right? Allowing all of that product mix out there. But then, I think what a lot of consumers don't realize, right, is that whole event, right, 2008 and prior, like it just really shell shocked consumers where, they would say, I'm never going to touch an ARM loan ever again. But then if we isolate that to the regulatory environment, right? So let's say we're looking at an agency loan product that's now done on an ARM, well, then I would say, is there a rate difference substantial enough to change that monthly payment, right? Because if you're on like an FHA or VA ARM and it's fixed for 5 years, number one, are you going to be in that home 5 years or more, right? I think that's the first thing to consider as a consumer.
Most people would say, well, I will maybe, but gosh, what happens if I'm not? That's
Right.
always the final answer when I talk to people about ARM loans. I've always gotten ARM loans. I'm always making moves, and I'm comfortable with worst case scenario in 5 years. Rates could be a little worse. Most likely they're going to be better, but that's some dice that I'll roll, especially with my investment being, my equity gains I'm going to get in the house.
Yeah. Well, and it's interesting too, because I think the one concept consumers don't think about when they're evaluating the ARM versus 30-year fixed rates is the entire mortgage insurance dynamic, right? So let's say you're going to be in that home more than 5 years, and let's say that rate is fixed for the first five, and now you get into year six, right? Let's say you were paying an FHA ARM. What you'd also have to evaluate as a consumer, if you're in that home for 5 years, was there enough appreciation in that
Yeah,
home to
that's a good point.
now waive mortgage insurance, right? Can you
Yeah.
refinance into a conventional
Let's
and
let's
drop the
back
mortgage insurance, right?
let's let's
So,
let's walk through that because what you
yeah,
just said is huge strategy. First of all, an ARM loan, like just to give an example, like a 5-6 ARM loan, the five in that number, that's going to be a fixed rate for 5 years. And then
that's
after
correct. Yep.
that, we are going to get rate adjustments. And those rate adjustments can vary, usually every 6 months. They can vary depending on the product.
That's correct. So the government arms right now, the 5-1, to your point, the second number means how often the rate's going to change, right? So the one is every 1 year. But if we're looking at conventional arms, right? Let's say you did a 7-6 arm. Well, you're fixed for the first 7 years. Now it's going to change every 6 months after that. And it's basically the spread off the original index, right?
So So let's say I go with an FHA loan and I do an ARM loan. So I'm fixed for 5 years. I put 3.5% down and I have mortgage insurance because you have to have mortgage insurance on an FHA loan. But I got a really good rate because of that. Because I went with an ARM, my rate has been lower. And that's really given me a comfortable payment. Let's just say 5 years go by and the home has done very well, as most homes do. And you can project this. You can have your real estate agent, you can have your lender. And all of a sudden, we can now refinance out of the mortgage insurance and flip it into a conventional loan. When you do that, even if the rate is the same, even if conventional rates have gotten a little bit worse, the likelihood that you're actually going to improve your budget, your payment is pretty high because you're going to drop the mortgage insurance. So use the ARM, get a great payment, use the market to pay you equity, and then hopefully you can refinance into a conventional loan. I think that strategy is something to look at.
It's definitely something to consider, right? And again, every buyer has their own personal risk threshold to this. So again, it's always buyer's discretion, right? The buyer's opinion is the only one that really matters at the end of the day. But I do agree, these things should be taken into consideration because, let's say we're looking at, 500, $600,000 loan amounts. If let's say the ARM rate is 1% lower than the fixed, you know, fundamentally, you're probably reducing and offsetting the mortgage and interest payment at the fixed rate, right? Because of the payment reduction. So let's say you fast forward 4 years and you save $200 per month, right? Just on average in that scenario. So if you're saving $2,400 per year, right? And you're going to do that year over year over year, that's a lot of money. Because even if we just isolate that to 2 years, now you've saved $4,800. If we extend it out, to 4 years, you doubled that 4,800 in your total savings. But again, if we look at appreciation rates, very far and few between that they go zero or negative. So then if we go back to that 5-year ARM concept, right? And you want to try to drop mortgage insurance, well, let's say you wanted a 20% equity position in the home 5 years later. What's the likelihood the home's going to appreciate at 4% per year? In a lot of areas, probably pretty reasonable that it would appreciate at 4% per year. And if it doesn't appreciate at 4% per year, let's say you're refinancing into a conventional loan, that cost of mortgage insurance is going to be fractional at, an 85% loan to value as compared to a 96 or 97% loan to value. So, again,
Yeah.
I think it's going to require bigger thinking.
Yeah. I think getting back to common sense, there's a risk. There's always a risk with an arm loan. It is you are risking that the benefit of that low rate is going to outweigh what happens after the fixed rate period. It is a risk. It is a gamble. We can call it whatever we want. It's a gamble. If you understood where rates have been and where they're going and where they flow, it seems more than likely that rates are going to stay the same slash come down a little bit. So it's a gradual decline. My point is that bet on a rate not going up in 5 years is pretty good versus if you lock into an arm right now in 5 years, it's going to be higher.
I agree. I
It'd be
mean,
like it'd be like locking an arm in COVID. If you did an arm loan in COVID and it was due right now, you'd be losing your because we're gambling, like we're looking at two football teams, like we have to know who's playing quarterback. I always say that, like who's playing quarterback? What's the defense look like? Well, right now I know what the defense looks like. I'm not guaranteeing a win, but looking at the market, I think the likelihood of rates staying a little lower than they are now is pretty high. Prove me wrong.
no, I'm with you. I think in higher rate environments, it definitely makes sense to think about these things and talk about them more often. I think here's what's interesting to me. Think of how often we're looking at transactions and consumers completely, are anti-permanent rate buy down right now. And for good reason, right? Because, let's say you're going to pay 1% of your loan amount and it's going to lower that interest rate a quarter or 3/8 of a rate, right? Well, if we look at the payment differential on paying that money up front, I mean, in a lot of scenarios, your break even is going to be somewhere between like 3 and 5 years out on that
Mhm.
buy down, right? So then,
If not longer.
exactly. Yeah. And then it's funny when you explain that to consumers, then their first reaction is, well, I don't know if I'm going to be in this mortgage, 3 or 5 years from now in this rate environment. So they're understanding that, and that's, kind of their perception and feedback on the concept of a permanent rate buy down. They're very confident, they're not going to be in that mortgage 3 to 5 years from now. And again, that's not us, right, directing that. That's
Yeah.
just them thinking through that from their own perspective and point of view. So what I think is interesting to me is they're looking at that from a fixed rate position, but the arm still scares people, right? If they say, well, gosh, it's only fixed for 5 years. Well, yeah, but over here, you just said
I
you don't
always
want to
say,
consider a buy down because
yeah.
you're not going to be in the mortgage 3 to 5 years from now, in your opinion. What's
I
making
always
this arm
say
loan any
we
different,
have
right?
to change the name of the arm. We have to call it something different because people associate it as all the negativity, which by the way, an arm is bad in certain rate environments. Like I said, an arm during COVID would have been terrible because, but who would ever do that? If I can lock a 30-year fixed at 2.5%, why the hell would I buy it down to 2.125? I mean, that's
It's in this environment too. Like there are going to be certain consumers they don't make sense for.
yeah, exactly. It's always going to be a customized approach for everybody. And I think
100%.
that's something I want to clarify for anybody watching. Your situation is so unique to you, your family, your budget, your goals, your grandma living in the basement, whatever you have going on, you need to sit down and get a customized plan because it's not going to be like anybody. If it's done right, it's going to be very unique to you. It's not a
It
cookie
is.
cutter.
Nope, I echo that sentiment wholeheartedly. And I think as you and I agree, I think the most dangerous thing for a consumer is to ask somebody in our industry, right? What do we think? Or what would we do? It doesn't
I
really
get that
matter.
all the time.
Yeah, it
Buyers,
doesn't matter, right? And that's the answer. It
I
doesn't matter what I think is right or what I would
yeah,
do in your
I
situation.
I get it all the time. I love there's
Yeah,
two things I get all the time, and I've been hearing it a lot lately. Number one is, well, what would you do? Like, just be honest with me, Tim. Like, what would you do? And the other one I always get is, I trust you. Like, I had somebody yesterday who said, well, I said, the market's pretty good. Here are the rate options. It's your decision. I want you to decide. But I've educated you on the market. I've showed you everything. We don't know what's going to happen. She said, I don't care. I trust you. And I said, well, you can trust me all day long, and you should trust me. but we don't know what Jerome's going to say tomorrow. We don't know what's going to happen on the market. So I am not the one to, I mean, you can trust me and you should, but you gotta, this is a risk. It is a measured risk.
Exactly. It should always be their decision,
Always.
never anybody else's. Totally agree. Yeah. So
No,
yeah,
that,
that's a
that's,
great add in here
that,
because you're right. It's
yeah.
all of these concepts exist, right? And I think our point of view collectively is people should just think about all this collectively because they're talking, I mean, in this housing market, we're talking large loan amounts, we're talking large monthly payments. These are big decisions to make. And I think people just need to be more calculated in their decision making
I
and
think,
again, look at it from a wider lens.
yeah, I think, what we can do as loan officers, the best thing we can do is take them to school and give them and teach them to be open-minded, teach them both sides of the spectrum,
Yep.
teach them the risk, teach them the reward, but careful because what you think a reward is may not be a reward to them. So teach them what the risk and what their reward could be based off of their goals. You may be trying to sell me on a reward that I don't want because you're a big time, big hot shot investor. That's the problem I think a lot of consumers have is they get advice from people who have 5 million bucks in the bank and they think, well, you want to be like me? And I'm not even near you. I don't want to be like you. I'm not going to make those sacrifices. I have kids in college.
Right.
You got to be really careful. I think as loan officers, we have to follow that same playbook. We have to educate them and then let them decide.
I think in this environment now, in this rate environment, consumers need more information and more knowledge than they've ever needed before.
What is one message from this week that one or two, whatever you want, that you would like to share or give to your realtor partners about the current landscape?
And it's kind of a layered message, right? But all the concern we're hearing right now, is the uncertainty in the economic environment. And yes, I mean, that is true. But then I would also position that and say, when is there not uncertainty in the economic environment, right? Like when do all of us know everybody's always going to have a job? The markets are always going to be positive. Like, is there ever certainty in the market? Probably not, in
Right.
my opinion. So, don't let your decision making be driven by fear. Instead, I think we're in an environment right now that just requires all of us, professionals and consumers alike, right? It requires all of us to evaluate a lot more data, evaluate a lot more decision making, and take our time with these decisions. I mean, we just have to dive deeper into things than we used to. And I think sometimes fear just causes everybody to just stop and just shudder and do
Yeah.
nothing, right? But again, markets are always going to be unexpected. Yeah, I mean, markets are probably a little bit more volatile than they are now, right? Because of the whole geopolitical
That's right.
environment. But fundamentally, we also
But you know
have to
what?
understand, like,
You,
do we think nations really want to tank the markets?
right.
I don't think so,
But
right?
you
I
know, do you
think
know
fundamentally they still want everything to be positive.
for as much fear and speculation as there is, I would tell all of my realtor partners and buyers that every time you've heard doom and gloom, whether it was a headline on CNN or Fox News or wherever, every single time you've heard, "Oh crap, the stock market's crashing," well, actually was a headline. We've had that headline twice now.
Hmm.
Every time that's happened, it's been a false positive. It's been a quick dip and recovery. So I would say to all my realtor partners and all my buyers, I would say don't get hung up on the headlines. And also on the second, and especially for the realtor partners, I would say focus on what you can control and only what you can control. And I'm stealing that line from Matt Ishbia. Ishbia said that in his Wednesday speech last week. And I thought it was brilliant. He said, you can focus on the market and become an expert on, this wasn't his exact words, but what I interpreted was like, you could be the expert on the bond market and the 10-year treasury. And like, I try to, know these things, but you know what, at the end of the day, there's so much more to focus on that you can actually control. Like I can focus on the weather too, but guess what? I can't make it nice tomorrow. I can't make it, so I would say as a real estate agent, business person, myself included as a lender, man, I'm going to focus on my clients, these products, becoming better at showing the full picture and helping clients the best I can without getting worried about the headlines. So that's just my 2 cents. I don't know. I'm feeling positive. I'm feeling motivational today. Talk to me, Goose.
I think it's, we all have to know what's behind the headline, right? Headlines are very polarizing, no matter where it's coming from, no matter your political position, et cetera. Headlines are always polarizing, I think, in either direction. But you have to know the information behind the headline
Yeah.
to know what's driving that headline, right? Is it really data that we need to be concerned about? Is it speculation?
Well,
Is
and is
it
it
emotionally
put out there
driven?
because it's drawing views? I mean, every
Exactly. Yeah.
if we can create if we create fear, we create views.
Yep.
And that's behind the money behind the media. So you have to know that. That's a good point.
Yep. Yeah, but I agree with you. I think everybody needs to know where to look at the data, and they need to be more informed now than probably ever.
Dave,
I think that is the takeaway.
that's
I
it.
totally agree with you.
That is a beautiful way to end it. Next week's a big week, as I mentioned. We have next week is Jobs Week, so Dave and I will be watching closely, and we'll be back next week for another weekly recap. If you are watching the program and you have a topic you want us to discuss, you can leave a comment, or you can send myself or Dave a text. Phone numbers are on the screen. That's it for this week, Dave. Any final thoughts?
No, I think you've said it the best, buddy. So I appreciate the
Awesome.
time, and yeah, hope you have a good weekend. Likewise, my man. See you.